¿Se me escucha bien? Can you hear me okay?
Amazing, Jorge. Perfectly.
We're good. Bueno, aprovecho a saludar a Soraya, que creo que está conectada, ¿no? Sé que probablemente no me puedes responder por el formato del Zoom aquí, Soraya, pero bueno, te mando un gran saludo y bueno, estamos pendientes para conversar otra vez próximamente.
Okay, we're ready to start. Good morning, everyone. Jorge, are you there? You guys can hear me, right?
Yes, I am. I can hear you
Amazing.
fine.
So,
good morning.
Good morning, Jorge. So, again, thank you everyone that's for being here. This is gonna be the first webinar from the Propfolio family, Propfolio Management. We're a full service property and asset management company. We manage $1 billion worth of properties. Myself, I'm Arturo Borges, the vice president at Propfolio. And this is a new initiative that we've decided to launch to kind of fill that gap that brokers typically don't fill when it comes to real estate investments and commercial real estate, right? And so this particular one is why real estate is a superior investment vehicle, and why real estate and commercial real estate should be a part of every single investor portfolio. Doesn't matter what you invest in and what is it that you do, it should be a part of every single well-diversified portfolio. So in this webinar, I have the pleasure to have Jorge Montero. Jorge is the business development manager at Riviera Point with over 25 years of experience in sales, in business development, and strategic planning. Extensive experience raising equity for real estate investment opportunities with an emphasis in Latin American markets. And he also has a particular focus on EB5 immigrant investor visa program and foreign investor prospecting processes. So to me, it's a pleasure to have you on, Jorge, today, just for a conversation, learn a little bit more. What is it that you do, how you do it, and talk a little bit more. And you have access. Give me a second. I'll give you.
Yes. I think I can open my camera now.
Can you put your camera?
No, it says I cannot start your video because the host has.
Okay, let me see.
Well, anyhow, thanks so much, Arturo, for this invitation, for having us here today. It'll be a pleasure to with you, your audience, your agents, in regards to our investment vehicles in this industry, real estate. So,
give me a second, Jorge. Man, I'm sorry, everyone, about that. I don't know what's happening. It looks here like you have complete access, you should be able to put your.
For some reason, it still pops up. You cannot start your video because the host has stopped it. So there's something. But in the meantime, well, as you were saying, definitely the real estate as a superior investment vehicle is the way to go. Most of us are trying to stay away from volatility, that type of risk. We believe the cash flows that are involved in real estate assets, mostly commercial real estate, are always something that we should look forward to when investing. We also have appreciation in value, most likely above many other types of investment vehicles or asset classes. And there's a positive leverage, of course, that is involved with this type of investment vehicle. Let's see if I can start my video now. Okay, for some reason I'm still not able to.
Yeah, no, give me a second, hold up, because it's gonna make.
We're all getting familiarized with these different
Yeah,
platforms.
right.
We used to another platform previously, GoToMeeting, and we switched over to Zoom as well. I think it's a great platform. We're also getting familiar with it. So, well, I would also like to comment that, of course, real estate investment vehicles offer, uh, higher equity growth and debt reduction. So that's important as well. We have the opportunity to involve ourselves as investors in projects that are syndicated by private developers through SEC exemptions. So that's definitely something positive for investors because the risk of getting involved with a mid-size real estate project is sometimes involved, of course, with the possibility of funding that project or not. And nowadays, Jobs Act and all these new syndication alternatives that are allowed by SEC, we can reach out to private investors that can, with relatively uh, small amounts of investments, 50,000, $100,000, and so on. And they can partner with many other investors, both locals and from abroad. So this is always something that helps us move forward these types of investments in our industry. We are
Okay,
particularly
Jorge. Yeah, so I don't know what's happening. For some reason, I'm not able to give you video access. So in order for us to just move forward, we're gonna just move forward like that. Are you okay with that? Just
I'm
to make
just
sure.
fine. I'm
Amazing.
just fine. I'll be a ghost here, but I'll be happy to speak.
Yeah, no, I apologize in advance for that.
That's fine.
But so to get the webinar started, pretty much, we. I'll share my. No, I'll put myself here. So why real estate is a superior asset class? Typically, individual retail investors see their investment portfolios hold hand. I think you would agree with this in terms of profits and or losses. But more sophisticated investors and institutional investors take into consideration many other factors and adjust those returns to risk, right? So I'll share my screen real quick. I have a couple slides for you guys today. Should be able to share it, right?
Yep. Yeah, we can see it just fine.
There you go. Okay. So why real estate, right? Well, personally, I'll give you this overview. Personally, why I love real estate is just I think that, and you're gonna talk a little bit more, Jorge, about international capital flows into real estate and different investment products within real estate. But I believe that real estate is where global capital wants to be, just because it's a tangible, stable, and historically has always trended upwards. 95% of of all the wealth that's being created in U.S. Has been in some way, shape, or form derived from real estate assets, either residential or commercial. We'll go into it further in the next slide. But real estate, I pretty much prepared this little chart that is going to give you an overview of why real estate versus other asset classes. Typically, the most common ones: stocks, bonds, and cash or savings. I believe that, to throw that one out of the way, cash and savings, we know that typically it's going to take you about 830 years for you to double your money in your average savings accounts in one of these major banks. Bank of America, your Citibank, your Chase account is going to take you about 850 years for you to double that. So having your money parked in a savings account is not a savvy, wise investment strategy. I think that we can all agree with that. But then real estate, it gets typically it gets typically compared to stocks and bonds. I believe that number one, before even talking about returns, and I always quote Warren Buffett on this one, is number one rule of money: don't lose money. Number two, don't forget rule number one, meaning capital preservation, Jorge, and to everyone, should be the number one factor in every single investment. If it's real estate, stocks, bonds, whatever vehicle, whatever investment instrument you choose to put your money in, you should always keep in mind, how is that money going to be kept, kept safely and be preserved. Number one. So the first point: high cash returns. Real estate has the ability to provide a healthy overall cash flow return to your investment, which is, to me, the number one pillar to preserve capital is going to be your cash flow. And if we look back to '08 recession, for example, other than the subprime lending and the financial collapse of the economy, really what didn't allow people to keep their properties was the lack of cash flow that they had in those properties and the over leverage. So they were over levered, and then they didn't have the cash flow healthy enough for them to be able to just hold that investment. If you have a healthy cash flow, it doesn't matter where we're at in the economy. It doesn't matter if we're here or there. It doesn't matter where asset values are. If you have a strong, stable, healthy cash flow, that's what's going to be able that's what's going to let you be able to pay your operating expenses, to pay off your mortgage, and to just keep that investment on through the entire investment cycle. So number two, equity buildup. Your returns are pretty much built up from the cash flow and then the appreciation. You have, your returns are pretty much the two things that build up your total return on the investment is going to be the cash flow it provides and the growth of that investment. You put $1 million in today, how much is that money going to be worth 5, 10, 20 years from now? So real estate has historically shown that, if you bought a property, probably if you bought a decent property in a decent location 20, 30, 50, 100 years ago, most likely that property went up in value, right? So
Right.
you have that equity buildup that actually stocks is that's the biggest way, or the biggest pro of investing in stocks, is that growth and that appreciation. The thing with that when it comes to stocks is that you, if you don't really know what you're investing in, you're most of the time you're speculating, right? And we come into an unknown area where you don't have control of your own destiny. You're just speculating, and just hoping, crossing your fingers and hoping for the market or that specific stock or that company to continue to go up in value. With real estate, you have that fundamented and that uh, you know thesis based equity buildup that over time it will go up in value with your cash flow. Then you have leverage. That's one of the biggest advantages of investing in real estate. Jorge, I'm pretty sure you would agree with this, is leverage.
Definitely.
No other asset class, really, most of them are not gonna give you the ability for you to lever themselves. And I always tell this funny kind of anecdote, which is, if you go to a Citibank, if you go to your local bank and you ask them to lend you money to buy their own stock, good luck with that. They're not gonna give you money to buy their own stock, but they would lend you money to buy real estate. So that should tell you a couple things on why real estate is superior. So leverage, your ability to not, if you have, let's say, $200,000 or 250, or let's say $1 million in cash, your ability not only to control $1 million worth of assets with that money that you have, but to control $3 million worth of real estate, to pretty much triple the cash flow, triple the asset value, and that's how you pretty much you maximize your wealth utilizing and leveraging real estate. Of course, it is it is a responsibility to tell you that it doesn't work like. Of course, you got to take into consideration many other factors, because you got to be able to conservatively leverage yourself. You can't just leverage your brains out. You got to be able to put a conservative debt. Conservative means whatever that means for a specific project, right? If you're buying a 1980 property, you're planning to renovate it and to sell it, to hold it 5 years and then to sell it, the type of debt that's going to be conservative for that specific project is different than, for example, doing a ground up hotel development in a growth market, right? It's different, but in terms of leveraging yourself up, you got to know what you're doing. You got to be able to put in, to assess risk and put in a conservative debt. But definitely leverage is one of the main advantages of owning real estate. Then it's a hard asset, right? What I said at the beginning, real estate is a tangible, hard asset that over time will go up in value. You can touch it, you can see it, you can visit it. There's real people living there paying real rent. You're not, again, speculating, you're just buying paper. You're pretty much, you don't have control of your own destiny, of your own portfolio destiny. That's a big one as well for real estate. And ultimately, the tax advantages involved in owning real estate, right? Typically, the biggest one would be depreciation. The government, the IRS, recognize that things and properties pretty much they deteriorate and they in paper go down in value. They say that 27.5 years is what it takes for a property, for a residential property, to pretty much to go down and just to get completely deteriorated. So they let you, and I'm not an accountant or an attorney, so definitely talk to your accountant, talk to your attorney, talk to your advisors, to the team that you build. To very importantly, we talk about capital preservation, Jorge. Yes. Not only investing in a smart, safe investment instrument, but also to have the team around you that's going to be able to execute on those investments for you. I think that you would agree that's a key point. I mean, who is managing this investment for you? Who is selling it to you? Who is managing your money? Who is executing the business plan behind it? Who is the team with the proven track record of success that's doing that for you? That's big. So again, depending on your personal situation, they're gonna let you pretty much it, depreciate the asset against the income that property is producing. And in some cases, depending on the investment cycle, the strategy, your personal financing situation, you could, potentially not even pay taxes on income property. You have then different strategies. You have different, incentives. You have 1031 exchanges, which pretty much lets you defer capital gains into the future. So if you own 100 unit, or no, it doesn't even have to be 100. You own 5 properties or 2 residential properties. When you sell, you have the ability not to pay taxes on that money, and under certain parameters and criterias, you can potentially, from the gain, you bought that $1 million and you're gonna sell at 1.8. You made that $800,000 appreciation gain on your investment. You can then put that money to work in a similar likely asset, and then pretty much not pay taxes today on those $800,000 and defer it and grow your wealth. So there's many different strategies that exist within the real estate industry and within real estate as an investment instrument are unique to it, and that's what makes it just a unique and beautiful asset class. Other than just, again, like I said in the beginning, just looking at the returns and like what makes me more money or what makes me less money, right? Here's a little graph on specifically commercial real estate. Like I said, here's pictures it very, very well. Less volatile here at the top, more volatile. Then we have high returns and low returns. So typically, and I'm a commercial real estate guy, so I might be a little bit biased to this, but
Oh, my.
typically, when we compare commercial real estate to stocks to REITs, these are real estate investment trusts. This is pretty much is like a hybrid between investing in private real estate assets and stocks. This is pretty much a stock. You're buying stock for real estate companies. It's not backed by real assets. Like for example, what I said in the previous slide, investing in a real tangible asset that over time will appreciate in value. Your investment is backed again by a real asset. You can see it, you can visit it, you have real people living there. In this case, in a REIT, you're pretty much, it's like investing in a stock or any other company that's publicly traded, but those companies are within the real estate industry. They invest. So technically, really the underlying assets are, are real estate. So you could say that's a nice hybrid for you to have as part of your portfolio as well. And then you have bonds. So, you can see here again that when you adjust those returns to risk, typically commercial real estate ends up being an amazing and superior asset class. And then I would love to actually kind of narrow down or simple down. I've seen this very basic, but I've seen misconceptions about what's residential, what's commercial, what's this asset class, and within real estate we have three main asset types. We also typically say that there are asset classes. Asset classes are pretty much the ones I just described, but this is asset types within real estate, within the real estate industry, which is residential, commercial, and land. With residential, very simple, we have pretty much condos, single family homes, and townhouses. That's what makes up the residential real estate industry. Then we have the commercial, which is pretty much retail centers, retail as an asset type. We have office buildings. We have, people have many different ways to putting it together, but we have hotels as well. What else do we have in commercials? Pretty much the broadest and the bulk within the real estate industry is going to be commercial building. And then we have land, which is pretty much just buying a piece of land, developing, and then just going vertical on a construction. So you have those three, and then you have specialty assets like you have schools, you have universities, you have churches, and different types of specialty assets. And then and with this, I'm going to wrap up so we can actually bring the superstar of the webinar and come in and just have a conversation and get to learn a little bit more what is it that you do, Jorge, and
Sure.
go from
Thank you.
there. But pretty much, and I love this because I always based off my, again, we manage $1 billion worth of real estate, and we're constantly advising clients on what they should do with their money and how to strategically position it for cash flow and for growth. And so I always go based off this spectrum, the risk return spectrum. Again, I always talk about risk. What's your return expectation versus what's your risk appetite, right? And so we have the risk return spectrum, which is comprised of core plus, the value add, and opportunistic. This is how I love to see it. And pretty much every single real estate investor is gonna be in this spectrum. So pretty much in core, it's gonna be, I typically see it as core, the more institutional investor. Why? Core is an investment that's, in the name says it, it's just a conservative. It's you're positioning yourself in a probably in a class A market. You're positioning yourself in a new property that's cash flowing, that's stable, and you're pretty much trying to just park money for capital preservation and long term holding. That's pretty much it. And this is typically the this is not a blanket statement, right? But this is typically seen in more institutional investors, Blackstone and BlackRock and Brookfield, these big institutional investors. The biggest issue they have, and you would agree with this, Jorge, is they have
Yeah.
too much money, right?
Yes.
And so when you have too much money, when you raise money from investors, you have too much money. You got to put that money to work. You're raising money to produce for those investors. So the biggest issue these guys have is the ability for them to park that money, especially in a market as tight as the one and as hot as the one that we're experiencing right now. So core
Yes.
investments, they come in and they don't buy 20, 50, $100 million. They want to park in bulks of a billion, two, three, five, $10 billion, and boom, and buy an entire portfolio that they just want to, again, strategically park it. They are dealing with investors money. They want to just a conservative, high, just stable cash flowing asset in a great location that is going to over time appreciate in value. Then we have
Correct.
between core plus and value add. This is where typically and then the opportunistic as well. But typically, this is where is a perfect hybrid between, again, a conservative, stable investment, and then going all the way to the right side of the spectrum, looking and chasing for yields and better returns. This is where you buy an asset pretty much that is a quality asset still, that's in a good location, but that you're able to add value to it. You're somehow able to, it does have that value add component where you can come in and better the asset. You can, whatever, if it's a multifamily residential 200 unit multifamily property, you can come in, you can renovate the units, you can renovate the common areas, you can then increase rents by 20, 50, 75, $100 per door, and then you're going to maximize the value of that property. So this is where, again, you're buying quality asset still in a good location typically that you want to be in, and but you're able to control your own destiny. You're able to add value to it, and then exit. And then the opportunistic, typically, this is more of the, when you have the biggest, appetite for risk. And of course, you're going to get the biggest returns. It's typically ground up developments or any other strategies like, going for the investors that invest in foreclosures or tax deeds, whatever strategy is more of the, again, you're going for opportunity, or people that, for example, they see that retails, which I disagree with it, but that retail as an asset type is going to go away, right? And so people are flocking out of retail into other asset classes like multifamily or industrial. So what an opportunistic investor, contrarian investor would do is actually go into these assets where people are flocking out of, and just try to get that opportunity, seize that opportunity. And typically these are the guys that make the most money. Now, it doesn't mean that being an opportunistic investor and you in developing and doing ground up development means that you are just risking it, or
Right.
just
There, there's a difference between risk and risky, right? There's a difference.
exactly. And so you're not gambling, right? You mitigate risk, you assess risk, and you come in with the best strategy to to execute that business plan. But definitely the nature of this strategy is tends to be a little bit riskier. But now, with that being said, let me stop my screen. Give me a sec. With that being said, now I'm gonna throw the ball to Jorge. Jorge, first of all, I would love to start off by just you telling us a little bit more about your story, who you are, what you do at Riviera, and pretty much how you ended up in the best industry there is, and go from there.
Okay, wonderful. Can we have the share screen? You think that might work
You
on
don't
that
have the
screen?
share screen either. Give me a sec.
No, not yet. But in the meantime, well, thanks for the invitation, Arturo. It's great to be here again with your people. We know Propfolio has an immense audience, so this is a great opportunity to educate some of your people and your agents again regarding real estate as a superior investment vehicle. So definitely,
Right.
I agree with everything you said. This industry gives investors an opportunity to put their monies into tangible assets. We also have to think about the etymology of the term real estate. That's what it's all about. It's real assets we're investing in. And in fact, in Spanish, the translation is a little bit more unique. It's something like root asset, so that your capital is rooted to the ground. So it definitely portrays what this is all about. And again, positive cash flow.
Jorge, sorry to interrupt, but now you have the shared screen, right?
We do?
You
Yeah,
do?
yes, we do.
Amazing. Okay, keep on.
Right. Okay, so I'm gonna pop up my just a few slides we prepared for today. So as I was saying, positive cash flow, equity growth, debt reduction. You know, the 1031 exchange spoke about. That's a marvelous uh, tax resource that's available to investors through this type of investments. We always talk about the 1031 exchange to our investors in Latin America, where we basically market our investment products, and they are very amazed of how the U.S. The tax legislation works. This is something that creates wealth, as you mentioned, and it lets you prosper and defer your capital gains taxes under certain circumstances, of course. And again, we're not legal or tax experts here or giving advice, but it's
Right.
something that really helps our investors. Regarding our company, Riviera Point, Arturo, so we are hotel developers, commercial real estate. We've
Okay.
been developing office space in the beginning of our journey, and later then we understood that the hotel industry was much more prosperous. It's just a more proven business model.
Mm-hmm.
Uh, Definitely do agree with you with the fact that commercial real estate is, you know, the place to be. There's these economies of scale that will just provide uh, most likely better returns to investors. Uh, Again, proven business models, either through value add scenarios or
Mm-hmm.
opportunistic. We do both, by the way, mostly opportunistic.
Amazing.
So we uh, our projects from the ground up, and we have a very specific funding capital stack. We have
Okay.
85 investors coming in to every project, and I'm going to explain what this is about. First of all,
Jorge, before you go on, you said a very important term, that typically more sophisticated investors would refer to, which is the capital stack. Can you briefly just describe what the capital stack even is, just to get a little perspective?
yes, sure. Well, in simple terms, the capital stack would be the distribution of how the project is funded. I mean,
Okay.
how it's the mix is composed of. So we have equity investors in place in our projects. I'm going to talk about that right now. We also have senior debt, of course, and equity in each project. So that's what it's basically about.
Amazing.
And our projects, Arturo, are, well, you're mostly familiar with us, but we do have most of our projects in the greater Miami area, Florida. And currently we have a Trip by Wyndham project, which I'm going to show in the following slides. Anyways, Miami is a primary market. This is very important because sometimes investors coming into real estate are coming into secondary or tertiary markets, which are also wonderful markets to invest in. But it's
Mhm.
always it's good to come to the primary market where there's definitely less risk. These type of markets are more established markets, more robust markets. So the chances of being successful in feasibility under
Mhm.
these type of primary markets are much higher, of course. So, well, we have, the Miami International Airport, corporate America, headquarters and bank, and global bank headquarters in Miami. Uh, Freedom Park coming up real soon, right next to the Miami International Airport. Our beaches, of course, and Latin American investment, and from well worldwide, of course, but specifically again, we work with Latin America. And we're seeing lots of investors coming in these past few years, and you won't believe it, but in 2020 we had a very good hike in investors because after the pandemic, people are looking forward and thinking of how they can diversify their risk, and they're actually taking their monies out from their Latin American countries and bringing it to Miami.
For sure.
And the facts are the facts. So we see Florida as the fourth state in gross domestic product (GDP). So this is mostly due to the Miami economy. This is something that has been consistent for throughout the past couple decades, at least. So this is something that really important for our projects as well.
Right.
And
So
trying.
before you go into the EB5, just to get a little context, we know that governments pretty much they can't do it all. We know that, and typically they're not necessarily the most efficient mechanism at improving areas and creating economic prosperity without the private sector. So what they do is create different types of programs and incentives to encourage investment and economic growth, just like the 1031 or the Opportunity Zone Initiative and all this. And the EB5 visa program is one of those programs that allow that economic incentive and prosperity and growth. So that's what you guys, I believe, specialize in. And now, understanding that what is it, what's EB5, and how can a regular investor can leverage that.
Correct, Arturo. Thanks for stating that about the AB5 program. So, and why is this important today? We're speaking about why real estate is a superior investment vehicle, but it's also important to understand the risks when investing in real estate. And one of those risks is definitely involved with the funding of each project. So, if an investor can come into a project and have fellow investors coming in uh, by by many by the dozens from other countries and locals, of course, and that's much better because that way risk is definitely mitigated. So that's what the EB5 program uh, is about in a sense, because the EB5 program was legislated by Congress back in 1990, and it calls out to foreign investors who want to invest their capitals at risk in specific projects that are in what is known as targeted employment areas. So these are specific areas where the government wants to create wealth and job creation. So these people invest, a fairly important amount of their money, $900,000, into these projects, and they obtain their green card together with their spouse and children under 21. So this is definitely something that provides constant investment flows into our commercial real estate projects as well as many other projects that work with the E5 program nationwide.
Amazing. And just so I know, I'm curious because I used to be, and correct me if I'm wrong, but I used to be like $500,000, right? But when did it change, and how do you see, and how have you guys seen? Well, first of all, do you know why that happened, and then what have you seen in on your end that affect you guys' ability to continue that program within the company and raising money for projects?
Well, that's a great question. The reason why it increased, Arturo, is because uh, since 1990, those $500,000 that were first in place have definitely gone through an inflation process.
Right.
1% per year, but indexed to today would be more or less. We would talk. We would see like a 1.4, 1.5 million figure. Nevertheless, it was increased maybe halfway, $900,000, and this is also helping in processing times at USCIS, Immigration Department. It was just too many applicants worldwide at $500,000. If you look at the results of investing in gains, they're fabulous. It's the green card, which will take investors, lead them directly to the U.S. citizenship. So that's the reason why it had an increase. And we did,
Amazing.
and it's good you asked me about our how things have changed on our side because we have made certain tweaks on our capital stacks. So I did want to go ahead and talk about that
Amazing.
with this slide. Previously, we used to have maybe 40, 50% of our projects funded by the EB5 program investors. Nowadays, as you can see, we're about at 20%. This is it depends on each project, of course. Each project is has its own business model and econometric analysis. So depending on what what that data brings up, we will know how many investors can actually participate in each project. So we have this beautiful mix, which makes investment in real estate through these types of projects, which are commercial real estate projects again, where we're going to have a historic NOI or net operating income, which we basically know what the market is going to perform like. They're opportunistic projects, but we have again a diluted risk because we have both the EB5 investors and private equity investors in place as well as the senior debt. The other important factor here is with these types of opportunities that the U.S. Government gives us developers here in the United States, we can also translate economies to equity investors because EB5 investors are coming in to bring their families to the states. That's their main objective. So they're not going to participate in very attractive uh, annual returns and much less capital gains. So
Mhm.
specifically with this capital stack for this project, we have $9 million that are coming in, and these people are going to be very happy when they receive their green card, but they're not going to get a significant pref, and they're not going to participate in the capital gains of the project. So all that return is going to uh, translate to the equity side of the project for equity investors. So that's a way of mitigating risk, definitely for equity investors as well.
Amazing. Okay. And so just to explain briefly what a pref is. We're talking about a pref, a preferred rate of return, which pretty much means, and I'm actually, you have your screen shared, but I would love to, me, yeah, give me it quickly, Jorge. Can
Mhm.
you see my screen?
Yes, yes, we can.
Amazing. Just to briefly explain the capital stack, just on over, just like Jorge said, pretty much it's just how the capital, how money flows within a real estate transaction to get it funded in the residential space. Like I said, that's why these building blocks to understand what real estate is and why it is what it is, and then you build up from there. So in residential, you typically just have someone that's gonna buy a property that provides you typically call it the down payment, and then you finance it with the bank, and you just buy a residential property. But when you go to more complex transactions and commercial real estate, bigger projects, there's many different ways you can actually put together a deal and get funding for that deal. And so the capital stack is pretty much just this concept that it establishes who who gives what kind of money and then what kind of return and risk they're taking within giving that money. So you have senior debt. This is typically what in a residential transaction would be the bank. This is the one that's putting in the most money, 50, 60, 70, 80% of the transaction, and they're the first one that are going to get that are going to be paid, just like what I was saying. Then there's the mezz and the preferred equity. This is like a hybrid product where you come in and you again you it's all about return expectations and what risk you're assuming with those returns. This is like a hybrid where you get better returns than you would providing senior debt to the table, but you're not assuming as much risk as common equity, which is pretty much what typical investors would put money to. So we're gonna buy a $10 million property. We're gonna put $3 million of common equity, and then we're gonna finance that with senior debt. And so what Riviera does, this is a very blanket, like simplistic way to see it, but they say you come in with common equity. Well, the EB5 is different. You can explain that a little bit further, but I'm talking about the pref equity, the providing a preferred rate of return to investors is, listen, in order for us to align our interests with those of you as an investor, we're going to provide you with the first 6, 7, 8% that investment produces. Is going to be entirely for you. After that gets paid out, your initial investment, then that's when we're gonna split profits. That's pretty much it. But you're pretty much
right.
sitting across this capital stack. This is how a real estate transaction gets funded. Again, the more complex, the bigger the deal, the more layers this is gonna have, and you have a hybrid between mezz and pref equity and senior, whatever it is. But this is very important for you guys to understand. Later on, we'll put it together nicely and provide you with all this information. But I just wanted to point that out so you better understand what Jorge was talking about.
Wonderful. So that was great to have that slide. And yes, when people are looking to invest in real estate, it's always best to try and come into a business model where there's a preferred equity position. It's just less risky, of course, as you explained it, and then comes the waterfall, which is the order in which people get paid. So under a preferred partner position, you have a much better chance, of much lower risk of getting your returns and your initial capital contributions back. So it basically puts the developer, promoter in second or third place. So they will always want for your investment, for the project that you're participating in, to be as successful and as feasible as possible, because otherwise they're just not going to make any money, because they're going to be in first place as a pref partner. So yes, that's the way we set up our capital stacks and our legal structure. We have the preferred partner figures for our projects. And the good thing is that EB5s, again, are giving all this money to each project. And it's like having a partner who basically invests with you in a deal, but is not expecting a return. They're expecting for you to let them into your store. Let's put it in those terms. They want to come into the United States, but they're making their own gains in that sense.
Right.
So we have an example here of what a typical legal structure would be under these type of equity investments. So each project is made up through a new company. We form a new LLC, and then we have different types of partners that come in place. So the good thing is that capital contributions from our equity investors and EB5 investors are backed by the assets. So we have to go back to what we spoke about in the beginning, tangible property, less risk. And again, cash flows, predicted cash flows. We have, all this Smith Travel research related, at least to hospitality, that has to do with how the markets have performed in the past. And I always like to say that, market analysis and data is very consistent in our commercial real estate sector. I know you guys are also involved with multifamily, I believe, from Millennium Park in Orlando, and there's so much data that is very consistent with the historic data is very consistent in the future with what works out and how the asset performs. Right. So this is very important, less risk. So this is definitely the type of model in real estate where we would like our investors to to look into, whether it be in our projects or any other projects, of course.
Got it. So Jorge, bigger picture, going a little bit, along the lines of why real estate is a superior investment instrument. I know Riviera Point, I know you, and I know the kind of product that you guys deliver. You've been doing it for a while now. My question is, why would the type of product? I will actually see if you have an actual tangible, of your products, so we can see what you've done and why do you guys consider that that specific type of product is a superior investment instrument that investors should get their money into, and yeah, that's pretty much
Yes. Well, of course, this is we're in right leaving exiting the pandemic right now. Of course,
right.
so, hospitality is not the best performing commercial real estate asset at this moment in time.
For
Uh,
sure.
Here at Riviera Point, we have several um, hotels that are currently operating, and they've struggled, of course, like many other hotels throughout these past few months, past year. But
Mhm.
we've kept doors open. Occupancy rates have been increasing, and I'm just saying this because the hospitality sector has historically been very prosperous.
For sure.
The data has always been prosperous. We've had high returns. Our investors have gotten both their capital contributions back, and it's a very good sector to invest in. So the good news is that if people invest in projects that are coming up in the next couple of years, or maybe 3 or 4 years,
Hmm.
they'll be able to make high gains on those type of investments. Currently, we have a trip by Wyndham hotel coming up in 2024. This is a sort of a hybrid type of product, by the way, because it has the boutique standards. Where guests are going to be accommodated in semi-luxurious rooms and the common areas.
Right.
But the daily rates are very competitive with booking TripAdvisor, so people know where they're going to arrive. So it's a very nice
Hmm.
product. We have this available under the same model that I spoke about before. We've been doing this for 14 years. And there's many developers in the United States. It's all about track record,
Hmm.
looking at who you're going to invest in. You mentioned it at the beginning. Of
Yeah.
course, real estate is a superior investment vehicle, but you do have to look at who you're going to be investing in, who's behind that project, of course. So what these type of projects are usually like, very much similar to what maybe you guys are doing as well with your commercial real estate projects. It's about having an investor come in with a common equity or preferred equity position, maybe having a preferred annual return,
Hmm.
and and after the project is developed as an opportunistic model and stabilized after maybe a couple of years of operations,
Right.
we will basically sell the project, and that's where we all distribute our gains. And
Right.
then our investors will take a split, it's usually between 70 and 75% of the capital gains.
Amazing. Okay, I love it. That project specifically, Oda, you have available right now for equity investors to come in.
Yes, we do. We have equity investor spots, units available. We also have EB5 units available. We do work, I want to talk to your agents maybe a bit here, and we do have referral fees for incoming investors, both for the EB5
Okay,
uh, spots or the equity spots.
got it.
And this is right next to Miami International Airport. It's just a very well strategically located project. High gains expected for this project in 2025, which is actually the year when we were looking at this position.
Okay, so hold on, walk me a little bit, so people can better understand what, for example, an investment firms like yours would do with either you're an agent or broker listening to this, and you want to see if this is a fit for parking your client's money into, or you're an actual investor looking to put your money to work. So you're pretty much gonna build a hotel, a boutique hotel, beautiful by the way. You already have the land, you have all the permitting or not, and then whatever it is that you need to do with the land, get all entitled and everything else. You go vertical, you build it. It's gonna take probably a year and a half, 2 years to build. Then you stabilize it, meaning for everyone, you pretty much get that again until the property is not stabilized. It is what I said at the beginning. It's you're pretty much speculating, right? Until the property is not stabilized and it's not creating and generating cash flow from the rents that's producing. In this case, from the hotel, from the rates, nightly rates that produces. It's just again you're speculating. So you get stabilized it, meaning you get everything rolling and everything's coming in. The cash flow that was projected in those performers are kicking in. Then you hold it until 2025 and then you sell. When you sell, that's when you're really going to make your money in the gains while you got paid a nice chunk of cash flow during those years just for your wait, right? Is that kind of how it works?
That's exactly how it works. You explained it 100% accurately.
Amazing. Okay.
That's how it works.
So
Yeah,
what I'm
or
gonna, yeah, go ahead.
I was just going to say that I always like to tell our investors that this type of business model allows them to participate in most likely high return opportunistic
Hmm.
business model where the land has already been acquired, so that risk is definitely mitigated. We have as the GP developer of the project, we have acquired the land with our own funds. We have the entitlements for the construction site, so we have a green light to move forward by the city of Miami. We have the hospitality franchise agreement executed and in place. So once we have all those risk factors under control, that's when we start to fund our projects, and that's the stage we're in right now. After that, construction, as you said, a couple of years to build the project, then stabilize it, and again, stabilization, as you said, definitely there can be variations, but in the hospitality sector, again, besides these exceptions like the pandemic, uh, data is very consistent. Net operating incomes in primary markets such as Miami are
Right.
most likely to be very consistent with the historic data. So that's what we're looking at with this business model, where our investors, by the way, take 75% of the split. So that's not a bad deal. Giving
That's
away all,
huge.
yeah, they give. We only keep 25% of the capital gains of the project, and we're last in place in the waterfall. So they have the best position, definitely as investors in these type of projects.
Right. Amazing, Jorge. Now, you know that, like I said, is the first the Propfolio Take webinar of the series, and this is all about adding massive value to agents, to brokers that we nurture a relationship with. We've seen that we are that resource when it comes to investments and commercial real estate, and agents across South Florida are using us, Jorge, to just propel the relationship with your clients through property management, asset management, investment opportunities, and this just educational content and material that we provide agents with. Now, that's from a real estate perspective, but with your 25 years and plenty of experience in sales and business development, eh, what would be a good piece of advice for you when it comes again to sales, marketing, or just overall business development for that agent or that broker when it comes to maybe I'm just thinking out loud on selling an investment opportunity like this, for example, like how can they position themselves as these investment agents, as these experts that listen, not only do I find you residential opportunities or whatever. I'm a very well diverse and versed real estate agent that has all this investment product being able to offer to you, and this team behind me that that supports what I do, and I've been doing this for many years. So on your end, what would be one or two pieces of advice when it comes to sales and or marketing that you would give out?
Well, I would say that listening to your client, of course, is the main issue. Understanding what it is they're looking
Right.
for. If they want a passive investment where they don't have to worry about tenants, maybe they don't have to worry about operations. If
Mm-hmm.
it's residential, even if it's commercial real estate, or maybe a plaza or any type of commercial real estate. These type of business models are very passive business models. So if you have clients that uh, want to invest their money under a very low risk scenario with attractive potential gains, uh,
Mm-hmm.
this is the type of investment that you could be suggesting to them. Now, if you have investors that are looking to live in the States, come and live the American dream, that would
Right.
be EB5, of course. And I do want to state, Arturo, that both EB5 and our equity investments are securities. So uh, we would be the ones carrying out the sales cycle with a potential investor.
Right.
Uh,
Right.
so the way this works is referral agreement. So if any of your agents does have a qualified, accredited investor that is interested in looking into these both
Mm-hmm.
scenarios, whether it be equity or EB5 investments, we'll be happy to take it from there and explain the whole process to them. Uh,
Amazing.
yes.
And just to be clear, you just made a great point that you only deal typically with accredited investors. What an accredited investor is someone that is worth $1 million, excluding their primary residence, or that they make $200,000 or $300,000 combined with their couple a year, and has the expectations of doing that same 200, $300,000 within the next 2 years as well. So that's pretty much what you need to kind of qualify as an accredited investors and be able to participate in the type of offerings that Riviera and Jorge does. Now, to wrap this up, Jorge, and call it a day. I've had a. What about you? I mean, have you had fun being the first Propfolio Take series?
Definitely, I very much appreciate you having us here. I learned a bit as well, so that's part of what this is all about. I hope
Right,
to communicate, important information to your agents, and this is also an opportunity for them to,
for
offer
sure,
some additional income if they wish to
definitely,
refer some
definitely.
clients.
And we're gonna share, Jorge. What I'm gonna do is we're gonna share all the information on what you guys do afterwards with all of the people that attended the webinar, so they can better understand what is it that you guys are doing, and just pretty much leverage and take advantage of what you're doing and how that can benefit them and their clients. So last question before we go, and this one is a question that I always like to ask myself personally, and I love it a little bit, maybe a little bit deep. So take your time. But pretty much, let's imagine, Jorge, that God forbid, you have 3 days left on earth, right? And everything you have, everything you've done, you said or written, you gotta take with you, and no one will ever know anything about you. You just disappear into the nowhere. But you're gonna have the opportunity to pretty much put in a piece of paper three truths. I call it the three truths question. Three things, Jorge, that you consider yourself to be, true. Three things that you have learned along the way that have driven you in your decision making along your life. You can live to your kids, to your friends, to your family. What would those be?
Well, I would say number one, being persistent. Being persistent in life is very important. Not procrastinating,
Okay.
leaving things aside, always maintaining your focus. Integrity would be number two. Treating others as you would like yourself to be treated,
All right.
and really following the rules.
Mm-hmm.
And last but not least, of course, family and friends. It can't all be about business and creating wealth and Of course, we all want to have that successful life scenario, but we have to sometimes go back and remember that family and friends is what it all started at in the beginning. So those would be my three.
I love them. You got it right, spot on. Sometimes I ask that question, and it takes a little bit of time to kind of think about it. But I loved it, Jorge. I really appreciate you being on and sharing your expertise, your knowledge with all of our audience. And hopefully we can do it again very, very soon. I wish you the best with Riviera, all the projects you guys have going on. And thanks everyone that attended the webinar. I hope you find it helpful and resourceful. We're gonna share all the information that was shared in the webinar with you, the slides and everything, so you can have it with you going over it. Again, the Propfolio Take is this initiative to further add value to specifically to agents, to brokers, to you guys, to become a better equipped real estate agent and broker and investment professional, so you can better guide your clients and ultimately add massive value to them and make more money to yourself and to them. Everyone's going to be happier. So again, this is just the first one. I hope you enjoyed it. We're going to be with this probably for now. It's going to be bi-monthly. So the next one will be in the next couple of weeks. We're going to have an amazing guest as well. And further, develop this community, right? Network, page free, and just, value adding that we're all gonna benefit from. Okay. So again, thank you very much. I wish you an amazing and productive rest of your week, and stay positive.
Thank
Bye.
you, Arturo, again. Bye bye.